What's going on, guys? In this video here, we're going to be doing a stock analysis on Google. Now, I actually haven't never covered this company before, so we're going to load this up in the stock research tool. Some interesting news came out with Google. An antitrust bill was passed by the Senate, and this kind of goes against the big old search engine that we all know and love. So with Google here in the stock research tool built by yours truly, we are grading this company a 9 out of 10 in our financial evaluations section. Now, what my software does, it takes a look at the balance sheet, the cash flow statement, the income statement, and then takes a look at these 10 key categories and gives it a number out of 10. So 9 out of 10 is a phenomenal score. Where it's only getting a point deducted is in our 5-year PE average, sitting at 34.41. We want to see this number to be 22.5 or lower. And with our company metrics category that allows us to compare the 5-year averages to the trailing 12 months, we have that sitting at 18.99. So 19 PE ratio compared to our 34.41 average PE ratio. And listen, folks, some companies can justify a high PE ratio if it is growing quickly. But in the case of Google, I don't know if that could be quite the case, considering it is a $1.41 trillion company. So we'll find out if this is justified or not, but right now we're ranking this as 0. Going forward, though, we see a lot of green across the board. That means Google is doing a lot of things right. A high current ratio sitting at 2.87. That means they have a lot of assets on hand to cover their liabilities. We would love to see that in case of an emergency and they have to liquefy any of their assets, they can cover those liabilities no problem. And in this case, as we go further and forward into a potential recession, this number may play a big amount into what's to come. So now, with a return on equity jumping into that, sitting over 15%, so it's going to get a point there. Massive EPS growth over the last 5 years, like huge. I should figure out a way to make this smaller, just to say either yes or no if it's growing. But I like to see a massive increase nonetheless. And a low debt to equity, folks. Guys, they're hitting the boxes in all the right categories. Debt to equity, we want to see this number underneath 50%, and sitting at 10.41 is phenomenal. The creditors have no hold on this business, or a very minimal hold nonetheless, and they're building this business through equity and not through debt. Huge plus for good old Google. Now, share dilution. I'm loving all this, guys. Look at that. Negative 2.21%. That means they are buying back shares, folks. They're buying back shares. That means you as a shareholder are owning more of the company, getting more of the profits, more of the earnings, more of the everything that's going to be going around. So we want to see this number decreasing, which it is, or at the very least staying the same, and Google's doing that. The only gripe I have with this, is if this company stock is overvalued. That means they're overpaying for the stock to buy it back. However, it is comforting to see this number decrease nonetheless. Huge net income growth, huge free cash flow growth, huge revenue growth, and as well as a return on invested capital sitting at 17%. We want to see this number over 10%, and we have that. And our trailing 12 months number, guys, take a look at that. 27.91%. Google is crushing it. Guys, Google is crushing it on all fronts, and like I said, the only gripe here that I can see is our 5-year PE ratio. High Altman Z-score, phenomenal Piotrowski score. We want to see this between 7 and 9, 9 being the highest number we can possibly achieve. So 7 is a fairly decent score, and just look at what they got, guys. Look at what they have. 5-year average free cash flow, $37.5 billion, currently sitting at $69 billion in free cash flow. This is a money-making machine, but you knew that. You knew Google would be a money-making machine. They control so much advertising, and here's the thing: a lot of these bills that are wanting to be passed, they're trying to break up the monopolization, essentially, of their advertising antics. But listen, you run Google Ads, you run anything through Google. If you're on the first page, you've made it, folks. You've made it. I don't know if my name is on the first page. Type in Leo DeLeo. We'll see what happens, and we'll see. Let's see if I'm up there. But nonetheless, I am very, very impressed with this business. So it looks like from our graph here, we've been on a slight decline. I mean, our 52-week high has been 3,042. Currently sitting at 2,100, and our range has been 2,000. So we are in a decline, like a lot of these tech companies. So it's very interesting. So we're going to jump into a price analysis, folks. And there's another section of my software here. I'll be able to put in different assumptions over the course of, we can go from 1 to 20 years. I like to do 10. From a conservative, moderate, and aggressive approach to try to figure out what a fair price to pay for Google would be. Now, before we do that, folks, if you are enjoying the video so far, hit that like button, smash that subscribe button, and there's a little bell icon for more videos like this, so you always stay up to date. And as well as this software that I have in front of me here, it may look rough right now, but guess what, folks? It's becoming an app for you to use for my viewers and subscribers, and I can't wait to show it to you. The finished product is phenomenal with more features and more items along the way. It allows me to analyze companies within an instant, so get very excited. So without further ado, I'm going to fill out these boxes in our price analysis section, and I'll touch base with you in just a quick second. Okay, folks. All right, so here's what we did. With Google, I did a 10-year analysis, and if you know me and how I like to operate, if you've been watching the channel for a while, I like to stay conservative as possible. I cut my revenue growth. I gave it a decent haircut. I can't see them doing 41% revenue growth over the next 10 years. It doesn't make any sense, nor does this 20% number look like it's very likely to happen. So I gave it a haircut of 15, 18, and just 20% on the aggressive side, but 15 is what I'm kind of hoping for. Considering it's a $1.41 trillion business, it seems more likely to be in this ballpark. Profit margin and free cash flow, I kept it somewhere where we currently have within the 20 range. So I did 20.5 and 21, as well as same thing with the free cash flow margin, because I believe they can hit that number, no problem. And with our price to free cash flow, I'm loving that it's at 20.52. I really am. So I decided to stick underneath that with the 14, 16, and 18, and PE ratio, excited that it's 18.99. So I decided to go 12 on the low end, 18 on the high end. So with that in mind, we're going to put a desired return in, and I like to do lucky number 13 to see what we got. Wow. Wow, I was not really expecting that. Average price $4,800, guys. Low end $3,000, moderate $4,900, and aggressive $6,500. $4,800 being our average calculation for Google with these numbers. Here I am thinking I was a little bit too conservative, and you know what? And not that I'm saying I'm not happy with these numbers, but perhaps I'm being a little bit too liberal in regards to how, or lenient rather, with how I put in these revenue numbers. This is actually, wow, I am actually astounded at these numbers, because who would have thought Google would probably be in the buy range right now? Like, I'm absolutely flabbergasted. I was not expecting this company to be undervalued the way it is. Like 6,500 on the high side. Now, granted, that is pretty high with revenue growth. I want to see if I put 10% revenue growth in just to give myself a little bit of margin of safety. If I did 10, 12, and 14, how low can I bring it? How low can I bring these numbers? So we're losing on the conservative side here, but 12% revenue growth, 14. Still attractive, guys. It's still an attractive buy. See, this is what I like. I like seeing companies that, if I can just increase my margin of safety and keep it dropping down even lower and lower, like even if I did 11, like when does this stop? Look at that. Look at that, guys. 10, 11, and 12% revenue growth. We're not quite there yet, the revenue growth on the conservative side. But what's helping us is that the share dilution, them keep buying back these shares. Huge revenue growth, huge free cash flow growth. This is looking very promising. This is looking very promising. Now, like always, more due diligence needs to be had. More due diligence needs to be looked at in terms of if I'm going to go buy this company or not. But I'm very happy about these prices. But that doesn't mean I'm going to jump in and buy this business. And likewise, you shouldn't either. You have to do your own due diligence. This is a tool that I've developed that helps you with that due diligence. You can compare, as I said, the 5-year ratios to the trailing 12 months. Look at where the company stands on the income statements, balance sheets, and cash flow statements. And finally, do a price analysis. And if you needed more information, look, guys, we have the income statements going back 10 years, cash flow statements, and balance sheets to get the full story. So if I had to look at a company like Google, I can see here the revenue. What's the story with the revenue? And it's constantly going up. It's constantly looking good. Let's go to the cash flow statement. Free cash flow. Amazing trajectory course. So here's the thing. Google, right now, it is in a buy territory. It is in a buy territory, but there's more work to be done. Anyways, folks, if you want to see a company evaluated with my software, hit me up in the comment section down below, as well as stay tuned. Stay tuned, because like I said, this will be yours. Stick around, and I'm trying to get this out as quickly as possible to you. But ultimately, I want to make sure it looks, one, it looks phenomenal and easy to use, and two, all the bugs are worked out, so that way when you use it, it's a seamless experience. And guys, we're just getting started. We are just getting started here on this channel, and I'm so glad to have you along for the journey. A lot of things are planned right now, folks. Anyways, much love. Thank you so much for watching. I will see you in the next video.